I think because gold is moving to all-time highs, meaning the dollar is moving to all-time lows, it means that the next round of inflation is already here. And you can even see it in the CPI numbers now, but it's about to get a lot worse. And then the question is, what's the Fed going to do when it gets worse? That's what's so hard to really internalize, that whether you hike rates or don't hike or cut rates, it's going to go higher. But you see, like on every piece of news that inflation's higher, or that there's going to be fewer rate hikes, gold goes up. That just proves that we're already in the late 1970s scenario here.
The recent release of the US GDP report on Thursday delivered sobering news of a notable slowdown in economic growth, coupled with persistent inflationary pressures. This development provided a noteworthy boost to the price of gold, which continued its upward trajectory for the second consecutive day on Friday. During the early European session, gold surged to $2,350 per ounce, marking a multi-day peak and underscoring investors' growing appetite for the precious metal. Rafi Farber, known as the Endgame Investor, offers a compelling perspective on the significance of gold as a currency rather than simply money. According to Farber, the rising price of gold is a barometer for the weakening of the US dollar and the potential for intensified inflationary pressures in the economy. Despite another U.S. inflation report revealing slightly warmer than expected data, gold and silver prices demonstrated resilience in early U.S. trading on Friday. This resilience contrasts the preferences of U.S. monetary policy hawks, who advocate for the Federal Reserve to refrain from implementing interest rate cuts to curb inflation. Farber parallels the current economic climate and the stagflationary period of the late 1970s, characterized by a combination of high inflation and economic growth deceleration. The March PCE price index, which rose by 2.7% year-on-year, surpassed expectations, further highlighting the economy's persistent inflationary pressures. In contemplating potential responses from central banks to these challenges, Farber points out the limitations of conventional monetary policy tools, particularly in the face of high debt levels. This suggests a complex and challenging landscape for policymakers tasked with managing inflation and steering the economy towards stability and growth. Come along as we explore Rafi Farber's valuable insights. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
Where we are right now, well, if we treat gold as not a currency, it's money, but if we as a currency, as you would look at, let's say, the dollar or Japanese yen contract, then the dollar is getting weaker in terms of real money. And usually when that happens, price inflation, as the Keynesians describe it, is not far off. I configured a chart showing how copper prices are very predictive of CPI numbers. It's the CPI numbers. I don't think they're honest or anything. It's not that I ascribe any power to them, but they do affect psychology, and I think they will be a factor in letting people loose and changing their mentality from, it's the economy strengthening to, it's the dollar falling. Because really all inflation is really the dollar falling, and the economic growth through inflation is all an illusion. It's hard to tell when it's slow because they can mask it. So I think because gold is moving to all-time highs, meaning the dollar is moving to all-time lows, it means that the next round of inflation is already here. And you can even see it in the CPI numbers now, but it's about to get a lot worse. And then the question is, what's the Fed going to do when it gets worse? And the only thing they can do is raise rates. But people are still in the false Keynesian conception that raising rates lowers inflation, what people call inflation. But that's only true when your currency is not 93% backed by debt that depends on interest rates. So all central banks are in the same problem now. If they raise rates, prices go higher. If they cut rates, prices go higher. So in that sense, I think we're in an unavoidable beeline to the end game. Doesn't mean there won't be wiggles. There will be, but the trend will be more obvious as the weeks and months ahead. And you can see that in the progression of articles that have come out over the last few months. Some starting with, there's going to be 4 rate cuts this year, and then 3 and then 2 and now 1. And now I just saw the first article that maybe there won't be any, and maybe we're in a Volcker-like situation. And don't worry, even if we raise interest rates high enough, everything will be fine eventually. And if inflation will be conquered, just like Volcker did, except Volcker didn't have to deal with $35 trillion of debt at 20% rates. It would bankrupt everything, and it would destroy the value of the dollar because, again, the dollar is backed by 93% debt, which plummets in value when you hike interest rates. So there's no way out of it now. We're headed there. It could take months, but the trajectory is really coming into focus now. And we're seeing gold move higher because there's going to be no rate cuts. It would move higher it would move higher if there were going to be rate cuts. But that's what's so hard to really internalize, that whether you hike rates or don't hike or cut rates, it's going to go higher. But you see, like on every piece of news that inflation's higher, or that there's going to be fewer rate hikes, gold goes up. That just proves that we're already in the late 1970s scenario here, which is exactly what happened back then, right? The interest rates that Volcker kept hiking didn't bring gold down and didn't bring prices down until I only learned this recently, but he had to hike rates to 20% 3 times, from 1980 to 1982, and eventually gold calmed down. But what Volcker didn't really understand is once you get gold to calm down, then eventually prices will start to fall. Just as gold leads prices higher, when it falls, it does prophecy. You could say that eventually consumer prices are going to go lower, because consumer prices are the last to be affected in any economic system, because they're the farthest away from the commodity space, which is the initial production stage. And by the time prices affect consumer goods, it could be months to years out, just by the nature of production.
Rafi Farber delves into the historical context of silver prices during the 1970s bull market, shedding light on its distinct role as the public's money, in contrast to gold, which is often associated more closely with banks. In 1974, silver experienced a remarkable catch-up rally after significantly lagging behind gold for 2 years. During this period, from late 1973 to the first quarter of 1974, silver soared by an impressive 125%. Interestingly, this rally marked the conclusion of the initial phase of the great bull market of the 1970s. However, the subsequent 2 years witnessed gold and silver prices declining by 45%, with gold stocks plummeting by a staggering 70%. Farber advocates adopting a monetary system featuring 2 separate currencies, one based on gold and the other on silver. He argues that such a system would afford greater flexibility and responsiveness to market forces, potentially enhancing stability in the monetary system. The concept of a bimetallic standard has been introduced previously. It has historical precedents, notably in the United States, where it was implemented in 1792 as a mechanism for regulating the value of money. During the 18th century, 1 ounce of gold was equivalent to 15 ounces of silver under this system, demonstrating the long-standing recognition of both metals as valuable and complementary components of the monetary system. Let's get back to the interview.
That in the 1970s bull market, let's say 1971 to 1980, silver did pretty much nothing in gold terms, at least, from 1974 to 1979. Didn't do anything. It stayed in a trading range with gold at about 35 to 40 per ounce, 40 to 1 ratio. And then all of a sudden, in 1979, it just went all the way down to 15 very quickly. And since I come from the Austrian school, I always look for a human action element in these type of things. And I think the explanation is pretty simple. Like the silver is the public's money, and it doesn't have much to do with banks. Banks don't have much to do with silver. They have to do with gold, which is why the gold price is really rising now, because it's the banks that are in trouble, and they're the ones that trade money and currencies. But when the public finally does wake up, what happens is they look at the gold price and like, I can't afford that. How am I going to eat? So before you have a rush into any good and service, what Mises calls the crack up boom, or the flight to real goods, you have you have the public, at least the wise public, going into silver first, and they'll just buy it and return it to the public because again, the silver was the public's money, and it's going to return to be the public's money. It's not. It's never going to be the bank's money. It's too bulky. It's good for the public, which is why 1873 was really the first crime of the first real crime of the monetary system. The gold standard enabled inflation because prior to 1873, we were on a bimetallic standard. Even that wasn't great. What we should be on is two monies, two derivatives of money. Right? You should have two separate currencies. One, let's say, is like a gold dollar, and the other is like a silver schmaler, whatever you want to call it. It doesn't matter. But if there's two separate derivatives for two separate monies, and then like dollars and cents, they would change every day depending on market forces, that would be the ideal system. It would have to be honest. So I do think that when the public does wake up and they realize that the dollar is collapsing and they're trying to retain their savings, the wise people of the public will first go into silver with whatever they can afford. And then once that's gone, or once even silver is too expensive, then you start the real hyperinflationary process where people take whatever dollars they have and they just buy whatever they can get. So right before we see a hyperinflationary crash, we're going to see silver go to 15 to 1. And then around 15 to 1, that should, I know this is an extreme statement, but I don't see any other way out of it. Once we see 15 to 1, I think the dollar will either freeze at a gold ratio that backs the Fed's liabilities by 100%, or if there's no gold in Fort Knox, it'll die completely. And then we'll have to start over, which is scary, but also glorious in the fact that all the insanity that is built up will dissipate because nobody will have any need for it.
Deutsche Bank has revised its silver price projections by 5% for 2024 and 2025, citing the metal's strong correlation with gold prices as a key factor driving this adjustment. Despite anticipating a mild correction in gold prices, the bank expects silver prices to temporarily decline from nearly $29 per ounce at last week's close to around $26 per ounce in the third quarter of the year. However, Deutsche Bank foresees a rebound in silver prices to $28 per ounce by the fourth quarter of 2024. Share your perspective in the comments below. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.